But man, I gave away the farm.
Today, I'm super excited to be here with Kevin Jones. He's the co-founder at Curate Telluride. He's also actually the owner and CEO of Latitude 38 Vacation Rentals, which is a property management company that started more than 12 years ago, that scaled to more than 200 properties, and that sold to Vacasa eventually.
You're never going to get it back. So be very careful with what you do with equity.
Now that you went through the process of scaling a company where you originally were not thinking of an exit and you ended up selling at the end of the day, you're building differently now. You're not bringing in investors.
We're going to stay boutique. We're going to maybe top out at around 50 properties and stay under control.
We've interviewed at this point more than 200 operators, some of them that are proudly boutiques, some of them that are looking to get in the hundreds of properties. It's really two different strategies. It's all about efficiencies, it's all about procedures, it's all about volume, it's about repeatability. What would you say if that's what it takes to be successful on the scalability model, whatever is needed to be successful at the boutique strategy?
Getting doors is one thing, getting profitable doors is another.
What advice would you give to people that are dreaming maybe of an exit? Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality. And we aim to talk with entrepreneurs, investors, founders, leaders, and operators in this space so they can tell us about the lessons they have learned, their stories, and also what we can learn from those lessons and maybe even mistakes so we don't have to make those same mistakes ourselves. Today, I'm super excited to be here with Kevin Jones. He's the co-founder at Curate Telluride. He's also actually the owner and CEO of Latitude 38 Vacation Rentals, which is a property management company that started more than 12 years ago, that scaled to more than 200 properties, and that sold to Vacasa eventually. So we're going to be talking about what are the lessons that he learned in scaling that venture. What are the lessons that were learned as well in terms of selling that venture, and what is he trying to do differently too in starting a new property management company now for the last couple of years with all these lessons in mind. So I'd love to start, Kevin, before we go into this story, with the question we like to open up with, which is, if you were to start all over again, which you have to some degree, right, knowing what you know today and having gone through everything you went through, what would you do differently?
Hmm. It's a great question. What what we are doing differently, right, is we are one using our own money. So I didn't use any outside money. It's my partner and I. We funded our new venture, Curate here in Telluride. Um, Previously, we had taken kind of friends and family money, and that was fine. It was a different time. It was 2008, 2009. Global economy was not doing so hot, so it was a good. We needed the money, the startup capital to get our company going. Latitude 38, um, but that gave away a lot of equity, right? And I knew going in that that's what it was going to cost me. And when we started Latitude 38 in 2009, we didn't have any visions of selling, right? Like we were just going to build this cool company, and we did, and we'd had no real. I mean, we had done a business plan and some forecasts of what we thought we could do for Latitude, and but we never really built it to sell it, right? So equity, while important, wasn't really super top of mind for me. It was more like, yeah, it'll be really cool to start this company, and grow it, and that's exactly what we did. But man, I gave away the farm, and no, it all worked out. I'm not looking backwards, and but that is you're never going to get it back, right? So when we started Curate this time, my partner and I, we had a lot of conversations about how that equity was going to get split and how we were going to invest in the company. And I didn't make that. I made a different decision. I was going to say I didn't make that mistake again. It really wasn't a mistake. It was something that we knew going in. but you're never going to get it back. So be very careful with what you do with equity. So that's number one. Know what your tolerance is. Can you afford it? Where's the money coming from? Are you giving up board seats? How much equity? You know, are you giving up a majority or a super majority? Right? Really think about that. So that was kind of number one in terms of what going back. What would we do differently, and kind of frankly, what did I do? What did I actually do differently when we relaunched in uh, basically 2023, 2024? So did that differently. And then the second thing we did differently, or I would do differently, is frankly we're going to stay boutique. You know, we're going to stay relatively small. That's our goal, right? We're going to maybe top out at around 50 properties, um, and stay under control. And you know, I say that now in hindsight, right? Like I think most people, if they start a company, they want it to be big, right? And so I did that, right? We did that with Latitude. We had 215 units. We were the biggest in the Telluride region, kind of Southwest Colorado, quite frankly. And um, when we got back in, we made a very concerted effort, concerted decision to not replicate that. So you know, like I think that that's a little more unique to me, and in my personal situation and my partner's situation, she had built another large company, sold it, was very successful, and we both went, well, let's keep it very much under control. So
Mhm.
those things, those were the two that jump out at me as to what I would do or
Yeah,
what I am
very good
doing
points, and a lot
differently.
to unpack there. So
Yeah,
let me start with the point on the equity side. All
yeah,
right. So a few things come to mind, and you said I wasn't building for an exit in mind
yeah,
necessarily. I didn't build to sell originally. It's funny because there's a book called build to sell, right? And it
sure,
talks about all of those things that when you are building for an exit, you have to keep in mind. And one of the key concepts is like the fact that you have to incentivize your talent. You have to motivate your talent. I mean, top talent, let's say management level talent, whatnot. Like there's an element of wanting to incentivize them, right? Should it be equity,
sure.
should it not? You're saying maybe not, right? And they agree with that in the book. Actually, in the book they say, well, if you need to incentivize top talent at some point, do it with a bonus, right? A
Mhm.
bonus in the eventuality of an exit, rather than the complexities that come with giving out equity. Now, when you look at this, how do you currently think about this element of equity as a tool to incentivize talent? Do you think there's still a room for things like that in terms of like stock options and things of that nature? Do you rather do profit sharing or other models, or do you think that that's not necessarily needed if you have the right culture and the right, let's say, compensation plan to begin with?
Yeah, I mean, I think it's different with you know, if you're a corporation, right? Like you're a massive corporation, you're going to give out stock because the pool's so big, and you give out stock. Or you have a big startup in Silicon Valley, and that's just the model of it. I think these, you know, our company was still relatively small, you know, with a couple investors slash friends. um, you know, now it's my partner and I. We're the only ones that hold the equity. I I think it's different. You know, I think if you have a big company, then giving out shares is one thing. Um, eh, I think with small companies, small startups, mom and pop shops, like most vacation rentals, I think you get into it's weird, right? Like, what if you have a bad year? You know, you have another 2008, 2009, and you have to do a capital call. And if you've given someone shares, I mean, there's lots of ways to structure it, I'm sure, but like very simply, if you've given someone shares in an LLC and you do a capital call, then they actually have to come up with money, right? Like very simply put. And like that's hard to give someone a gift of like, here you go, you've earned this. And then, oh man, tough year, or COVID happens and you have to fire. Like, what do you do? And I think because it is a mom and pop shop, it's a smaller company, it's a small town potentially. These resort markets are pretty small. Then you are letting other people into bed with you, right? Like, you're letting them see how much money you make. Maybe they go and tell their friends. Maybe they're telling their friends at a bar, right? Like, it's a very small town and stuff gets around. So I think there's a confidentiality side, a security side, a little bit. I honestly, we never, as we grew Latitude, we gave bonuses. We started getting into kind of some profit share kind of programs where, as profits grew, and we try to keep those metrics at a very high level, so you're not really getting into, well, you gave raises to people and that maybe dropped profit a little bit in the short term, and in dropping profit then hits their bonuses, right? Well, no one likes that, right? So there's a lot of dynamics. And so we've leaned more, like in the past with Latitude, and I think as we go forward, bonuses, and maybe they're performance based bonuses, their ratings, reviews based bonuses, just random thank you bonuses, things that are not tied to equity per se, because it just gets hard, it gets messy. So I don't know.
That's interesting. And also, now that you went through the process of scaling a company where you originally were not thinking of an exit and you ended up, you know, selling at the end of the
Yeah.
day, you're building differently now. You're not bringing in investors. So from that perspective, right, that's something different. Would you say that you're building to sell this time around? Let's say, like, forget about wanting to sell, but do you think that you're building with the structure of, like, I want to make sure that if I needed to sell or if I wanted to sell, well, at least I'm building that foundation with discipline from day one, or not?
I think it's a mixture of that, right? So I think what we also learned was to build a company that does scale, but also scales with potentially without us, right? So like, when I was doing Latitude, I was Latitude, and I don't say that with an ego. It's just like with any one of these smaller vacation rental companies, the owners are signing with you, the guests know you, like everyone comes to you 24/7, 365, like the company runs on you. That's how it was. And so the way that we're trying to create Curate is, let's not do that. Like, let's bring in really good resources who could potentially run this for us. So we're kind of doing that in mind. So it's not really, hey, let's build this so that we can maximize profit and get a great multiple and sell it. No, it's more so like, let's do it so that we could potentially step away, and not be here 24/7, 365, but be very comfortable handing it off to some key resources, let them run it, and we sit back and take paychecks, or bonus checks, distributions. So that's more so our vision, is to get it at a place where we get involved in the stuff that we kind of want to get involved with. Maybe I like kind of messing with pricing. Financial side, I'm interested in. My partner's like really good at the marketing and the strategy side. Let's try and do the things that we're good at, and then find the pieces that, where they can really truly run the business, and I'm not out plunging toilets. So that's
Yeah.
more so where we're
which
trying to
which
shoot.
which again, it's one of the things you would need to do if you wanted to build with an exit in mind. Is just you're doing it because you want that freedom and that optionality, not necessarily because you want to sell. It sounds like, so that's an
Yeah.
interesting mindset on this. Now, when it comes to what you just said about how previously you were the company in many ways, in many functions with Latitude, um, what was the hardest thing for you to detach yourself from when you had to start detaching yourself, because you know, of course, you start by delegating some things that are easy, maybe some admin stuff. Maybe after that,
Mhm.
you go into some, you know, guest communications. But then there's areas that start to become a little bit more challenging to really, you know, detach from as the owner. What was it for you that was hardest for you to detach yourself
Uh,
from?
yeah, hardest was the HR side. 100% HR, hiring, firing, um, performance management. That was the hardest thing. Maybe it's multiplied by where we are locally here in a very small market, and or people are driving in from feeder markets. Um, yeah, like I had really good faith in certain elements of the company, and then there were certain other elements that brought me the most pain and that were the most inconsistent. Um, and I think it all relates to the people in those sections. You know, like I think, and just to pick on things, like my accounting was really solid. My the sales reservations group, because again, a lot of people were doing actual sales and reservations at that time. It's much different now, but like sales and reservations, I knew what they were doing. I could see the results. I could hear them on the phone because people actually did use the phone at that time too. Uh, like you could hear them and you could hear them make sales. Great, right? On the property management side, on the asset care side, were people being efficient, right? Like, were they doing things in a way that I wanted, them to be done? Were the homes getting taken care of? Were the, like, follow up on tasks and work orders, and like just guest communication and guest interaction? Was that the high level of quality that we were looking for? So much of that stuff was out in the field. And so it's so much a trust me factor, and you can train it and you can show it and you can have all the kinds of different tools and stuff. But like when it comes down to it is, it's a lot of face to face, and you hope that that person's being nice and doing all the right stuff, or showing up, you know? So like that's that when it's more broadly like the HR, and the hiring and firing side was really tough.
And of course, part of that you address in terms of what you're doing differently here by being more boutique by design. I'm sure it's easier to keep an
Yep.
eye on these things when there's a handful of properties than when you have hundreds of them. What
That's
else
it.
comes to mind as far as what you might be doing differently? I mean, I'm sure there's also more tools perhaps available for, you
we
know, keeping
we had
track
a
of
lot of
that,
tools, but we
things like
like
that.
we probably had too many tools.
Too many
Like
tools.
again, one of the things that you had, the first question, right? What would we do differently? One of the things that I would do differently is not be enamored with the new bright shiny object, right? Like, oh, let's go do that. Or, oh, there's this new tool that they just launched, and I was at a conference, and God, what a great sales pitch. I'll do that. Let's sign up. And then like there when a new employee signs on and you have to tell them to like download 7 different apps, and you're like, ooh, that's a lot, like now. And like once you get into it, you kind of figure out which one does what. But like there's so many things and so many features and so many new twisty turny things that we just would jump into, and that's totally on me. So what we're doing now is like we took a very long time to pick a PMS. We took a very long time to pick a revenue management pricing tool, and a work order program, and that's kind of it. Like those are our big three, and we're trying to, there's all kinds of fun stuff happening, all kinds of AI tools that are out there, which it's absolutely the future, right? Or kind of the now, but like I don't know if I need it right now, right? Like I don't know if I need, given our size and our volume, different pieces of AI that will help step in and I don't know, answer phone calls. I don't know if I need
Mhm.
that just yet. So like let's just. I see it. It's smart. It's super cool. It could help. Maybe we wait a little bit until
Yeah,
you
and
know.
again, it's about sticking to the fundamentals
Yeah,
too, right?
yeah,
It's not necessarily because you have more tools that you're making the most out of them. It's usually the opposite because you
yeah.
end up being, spread too thin in some cases. So I think that's a very interesting approach. Now, let's talk about something too, which is the number two thing you said that what that you do differently. Like right now, was number one was the equity side. Number
Yep,
two is in terms of staying boutique,
yep,
right? Um, it's funny because when I talk about this podcast, I usually say, we've interviewed at this point, more than 200 operators. Some of them that are proudly boutiques, some of them that are, looking to get in the hundreds of properties or have
sure.
got in the hundreds of properties. And it's really two different strategies that are very, very different. So I think there's no right or wrong. I'm sure that some people that have done this scale, the scale type of model you did it,
Yep.
can be very successful. But it's all about efficiencies. It's all about procedures. It's all about volume. It's about kind of like repeatability. What
Profit.
would you say it takes if that's what it takes to be successful on the scalability model? Feel free to add whatever you think might be missing on that. What do you think is needed to be successful at the boutique, strategy instead?
I think you have to know who you are. I think you have to know what you're going to deliver. I think you have to know what properties, same thing in my mind, you want. Who do you want to work with from an owner perspective? That's huge for us. Huge. Um, and like we pick our, because we have that um, afforded to us. We can look at the situation, and I know the market really well. My partner knows people and properties really well, and so we talk about it and we go, well, do we want to add that one? Right? Is it going to do X in terms of gross revenue? Um, because I think getting 50 that do 20 grand, 50 that do 20 grand is different than getting 50 that do 100, right? Like, just do the math. And so, like, we're not solely focused on, oh, everything has to earn $100,000, but like, they got to be good properties. They got to be good owners. They have to rent well. The properties actually need to produce. I think we had a bunch. All of our 215 for Latitude. Some of those rented only a handful of times a year, and so you're like, well, if I'm doing property management 12 months a year and I get to rent it a month a year, 2 months a year, they're getting kind of free property management. Well, that's not a good deal. So I think you also have to understand, like, the what are you interested in? Are you like, getting doors is one thing, getting profitable doors is another. I would urge people to really look at the profitability side. We used to make a matrix, and my partner used to do it too. And it was like, like the SWOT analysis, but we'd put owners and properties in these boxes. And then on one axis, it was revenue, and the other axis, it was pain in the ass. And so if it was high revenue, high pain in the ass, maybe we think about it. But if it was low revenue, big pain in the ass, that's a skip. So you could have people just literally pull up a piece of paper, draw your put who these people are and how much revenue. So it's like a pain in the ass profitability equation, because probably the profitability, if you put them in their different quadrants, you could figure out what the profitability is on those. Do that once in a while. So I think for us, we've kind of just have gone in going roughly 50. This is roughly how we will you know get to 50 with this mix. And we'll make tweaks. It's not going to be perfect, but we'll make tweaks as we go.
I love that matrix, man. We'll try to see if we can come up with a
Yeah,
visual on that. That'd be that'd be
it's a
great
good
to
one.
that. But and then there's like revenue potential versus what
Sure.
you actually are able to achieve given the owner's, flexibility, right?
Yeah,
It's
and you got to make some. I've gambled. You gamble, and you go, "Oh my gosh, this house is so good." And right now, the owner's he's giving us she is giving us 60 nights to rent, making that number up. And you go,
hmm
but we're gonna perform, and
yeah.
that will convince them to let us rent 100 nights. And
hmm
then you go, at 100 nights, holy cash, that's great. Um, but then sometimes they change their mind. They go, I only want to rent two weeks. And you go, well, shoot. So I
Yeah.
think you got to make some gambles. You got to roll the dice every once in a while on some things that are um, could be worth it.
How does owner acquisition change when you have the approach of scalability versus when you're trying to select your owners so much and be so thoughtful of who you accept?
Yeah, it's a great question because I like saying yes, and I like winning too. I like winning the accounts. So I like the competitive side. Um, I think you have to step back. So do the math, right? I do pro formas on every acquisition, owner acquisition. I'm looking at them and going, or I can just do either a formal pro forma or something that's just off the top of my head because I know the area. I've been here almost 20 years. Like, do that math, right? And then really, to me, it's having the conversation with the owner. Ask them your set of 3 to 5 really core questions, right? Like, how often do you use your property? How often do you come to town? I'm here all summer. Oh, you note that down, right? Or, yeah, my kids come up every Christmas and New Year's. And you go, okay, there's that revenue. So you can kind of ask certain key questions about who they are and how they operate. If you walk into the house and it hasn't been updated since 1985, you go, okay, that says something about that. And I think you have to let people down easily because you don't want to hurt your brand, right? Like, you don't want to be the guy that, yeah, you get a phone call and they're really interested in your company and you never return their call. Well, that's not good. You got to return the phone call, right? You got to do the math. You got to have a conversation, but then be honest with yourself and then be honest with them. Like, hey, I don't know if it's going to be a good fit, but hey, you should go talk to so and so. I think that feels good. It's hard to do for sure because you want to win, right? You want to grow for the most part. But like for us, I think it's been super, super empowering. And it's a pretty good acquisition tool to say, we only have 5 more slots. If we're at 45, we're getting to 50, we only have 5 more. And people go, oh, I'd, I'd like to talk to you about that. Like, it's that supply and demand that ooh, I want to be part of the club.
Create scarcity for sure.
It does. It is. It actually, I've been surprised by that, the
hmm
scarcity bit. Like, huh, tell me more. And I'm like, shoot, I didn't even think you would respond.
Yeah.
So it's been interesting. So, and you can do that even at 200. Maybe you do it in tranches.
hmm
You say, well, we're only going to do another. We're going to get to 225. So we got 25 more slots. I mean, you could do it at different levels. It's just a different strategy.
Yeah, I really like that. Now, the other thing that comes to mind in terms of differences of growing the portfolios when you are doing the scalability model, let's go and grow as big as possible versus the boutique model. I mean, I would argue that there's more inventory that you can capture when you are okay with taking whatever, right? There's just more
Sure.
properties that fit the
Yep.
criteria of whatever than properties that fit the criteria of, like, they need to make more than 100 grand and have a nice owner and this and this and that. So that limits the pool of what you
Hmm.
can go after. And I would also argue perhaps that there's more rotation happening on the commodity side, meaning like, though, because they're difficult owners, they
Yeah,
might
churn.
have gone, and left this management company and be okay with moving on to the next one, versus, the owners you're after, if their properties make money and they're good people to work with, it's possible that they have a management company that would love to never see them leave.
Yeah.
How do you approach, owner acquisition under those circumstances? Like, have you seen most of the success come from going after people that have a management company and just trying to make the pitch about, why you're better? Or do you rather just go into the realtor side and try to,
Yeah.
get them once there's a transaction, or just new owners? Like, what do you think about everything I just said?
Yeah. I think any, like, I think the easiest, and they're all difficult, but the easiest is with the turnover of the real estate, because you get a fresh look, right? And so it's easiest. It's never easy, but like that's the smoothest, maybe. Versus trying to transition someone from one management company to another is hard. It's just the hardest. Unless that company is really really doing bad, then the opportunity is still there, but it's still hard, right? You have to deal with reservations on the books and linens and disabling websites and OTA things, on one side and it's hard. There's a lot of moving parts. So we always had the most success with realtors and transactions, right? So someone's they're buying a new unit. You can get a nice introduction. It's fresh, from a broker. The brokers that we got most of our business, Latitude ways, and about maybe half of our current portfolio is referral, kind of word of mouth. Um, it, the brokers, I always used to say the brokers are like the client's first friend, right? Like they come to town, they're skiing, and they don't know anyone potentially. But then what do you do if you're there long enough? You start looking at real estate and you're looking at the magazines and stuff. We do it every time. Um, and then you reach out and you talk to a broker. And that's like, that's your first friend, right? And your first friend then says, hey, you know what? You should go talk to Kevin. And you go, so that it's a great lead in, right? And then they go and they buy a really expensive property, and you start fresh. So that for us has always been the best way. So being a broker's best friend is super, super key. Being Johnny on the spot, to give them pro formas, to answer questions. I would tour their clients through homes and talk to them about the rentability of a house, or hey, you might want to do X, Y, and Z to get the house ready for rental. Or ooh, at putting my management hat on or caretaking hat, I'd be like, that boiler looks like it needs to be serviced. So I give them some heads up, all trying to get that sale to happen or that purchase to happen, and then that referral comes back to us. So like being the broker best friend, and I never asked for a commission on that side, probably should have, but like what I got was a referral, and then keeping that going with those real estate agents is great. Was a really good.
Did you find that giving the real estate agent a commission move the needle with them? Because again, they're making so much on the transaction itself that, like, sometimes just this little bonus here and there, it's like
They like
not
thank yous,
like,
they
thank you
definitely
more than
like gifts. So like I think something's probably better than nothing,
yeah,
and I'll be honest, like there were times where we were adding so many so fast that we would forget, and then
yeah,
they remind you and you're like, ooh, that's that's bad. So remember to say thank you,
yeah,
some way, shape, or form. A restaurant gift certificate for a couple $100, it does
yeah.
something, like on a $5 million sale, it's a huge commission, and you're going to potentially make a bunch of money on the rental side, give them a give them something.
Yeah, 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 for sure.
Say thank you somehow.
Mm-hmm. Mm-hmm. Yeah, no, that makes sense. Now let's talk about the process of you growing the management company to the level you
Mhm.
did, and then selling it to Vacasa.
Sure.
Let's I guess, what's the story behind that? How do you go from not having an exit in mind when you started
Yeah.
to, you mentioned timing was very crucial to your, transaction specifically, but how did that happen? Let's start with the
Sure.
story, and then we go into what you learned from that.
Yeah, the story was so, if you have a pretty decent company and it's happening to a lot of companies probably every day, right? They're getting calls now from private equity companies. Um, we were getting calls throughout our time, not immediately, right? Like that was 2008, 2009. Man, we get the occasional call started happening once you get up to a certain size. Yeah, once you crest 100, you're kind of you're on certain radars, and we would get phone calls from just inquiries from the bigger companies that are out there, like yeah, Vacasa, Natural Retreats, other branded companies would and they're all different now. So but like at the time, there were a bunch of companies out there that have they would have employed people that would go around looking to acquire. So you get the occasional phone call, and some sorry about that. Sometimes you do the dance. Sometimes you don't return the phone call. You know, and as we were getting through 2020, or even before, we were getting more and more phone calls because we're pretty good size, good portfolio. You definitely are more on the radar. Um, COVID happens, and like everyone, of course, freaked out because, oh my gosh, everyone's business is going to shut down. And then the inverse happened, where everyone's businesses kind of just went crazy, at least from an occupancy standpoint, rates. Um, and we saw that too. And so we didn't, those two things weren't tied together, right? We didn't use the COVID bounce to then sell. COVID kind of didn't have anything to do with it. But we finally got a phone call, um, and they started getting more serious. They got we started talking numbers. You sign an LOI, you circulate some high level profitability numbers, um, and cash flow numbers, or what future reservations look like numbers, and you get an offer that comes back. And finally, the offer from Vacasa got our attention. Quite honestly, it was like, oh, wow, that's interesting. The offer came in kind of late 2020 into 2021. There was a lot of things going on. So Vacasa was in a super growth mode. That was pre-IPO, so they were going around buying a lot of different companies. They bought us, and I think we were like the second largest company that they had purchased, and I felt all good about that. And then they bought Turnkey like the next week, and I was like, oh well, I guess we'll slide down the list there. So they were, and honestly, they were very good to deal with. They did everything they said that they were going to do. The other thing that was happening during that time, and we did use it to our advantage, was Airbnb IPO'd at that time. So we used that, and I mean that was a rocket sled. So we just pointed at that as, hey, I know the businesses are different but related, but we use that as, look, see what happens, so like we use kind of that to our advantage. So that was good timing. And they were very good to deal with, truly. So we got to the point, signed everything, the terms of the deal were quite good and favorable. Everything that you're kind of looking for. You don't really want big long tails, and retained earnings kind of um, things. I had short non competes, like all the things were really good. So we sold.
So it wasn't like, oh, should we do this? It's our baby. Like thinking twice about it. It was kind of like a no brainer because the offer was so good.
Oh, it was definitely my baby. I cried like a baby. I will be super honest with you. The moment we closed and you actually looked in the bank and saw that the money had transferred and you were like, okay, this is real, I sobbed because it was my
No
baby.
way.
I totally,
Wow.
totally did. Uh, and because it was my baby, like it was everything for me for the 12 years,
12
right?
years, man. It's a
I
long
also had,
time.
my partners. I had tried to buy out my partners. I'm telling everyone all my dirty secrets, but I tried to buy out my partners. They said no. I tried to like basically, I tried to buy more share. So I tried to buy them fully out. They said no, that was their right. I tried to buy more share from them. They said no. Again, that was their right. All before. So I kind of wanted to quote unquote take it private, right? And just own it all myself. And they had the right to say no, and they did. And so that was a bummer. And I think, in our partnership, it had just kind of come time as well. We'd worked a lot, we'd been through a lot. Uh, Lives change, people change, and it was also partnership wise, it was kind of ready to go too. But it was
Hmm.
still my baby, and I sobbed like a baby.
Damn. And people say that due diligence process can be
Oh
very stressful and very, time consuming and
oh yeah,
whatnot. What advice would you give to people that are dreaming maybe of an
yeah,
exit, want to work towards an exit, of things that maybe you learned during the diligence process? You're like, oh, if only I
yeah.
had done this before.
I'd say a couple things. Number one is make sure your books are clean, like just clean. And not clean as in, like, I know a lot of small companies, you're pushing your life through your P&L. That's fine, right? That's all cool. Know what's in there, and then know what to pull out, right? So
Hmm.
know how to normalize your P&L. And
Hmm.
then, so like, normalize the P&L, because if you just take it from QuickBooks, you print it out, you send it to them, it's going to say X. If you go, well, shoot, that has my healthcare and it's got my kids' phones on it, whatever else, like, take all of that out, right? And
Hmm.
disclose it, right? Like, hey, my life is in here. I'm going to remove some of my life. That will change your profitability to something different. And then what I did was I knew, and this ties into the second thing. I knew who we were selling to or potentially selling to, and I knew what they were going to do, right? Like, we had accountants, salespeople, I had a pricing analyst, I had all kinds of property managers, I had a tech person. Vacasa doesn't need my tech person. They don't need my pricing person. They don't need my reservationist. So I knew, shoot, they didn't really even need me. They were going to have a general manager. I pulled all of that out, and I'd say to them, okay, so if my profit was X, I'm going to pull out some of my life that's in the P&L, which we had very little, anyways. And then I'm going to pull out all the things that I know you're going to pull out. So
Hmm.
my profit, what you're going to buy, is this normalized profitability, and then take that number times a multiple. Don't take your bottom line straight, what you're telling the IRS, and take that times a multiple. Do some math, right? Normalize your P&L. That's really important because you're negotiating, right? And if that profit number is bigger number times a bigger number is a bigger number, right? So that's very important for negotiating. Second one, I did everything by myself. Like, my investors were kind of involved, but like, all the due diligence I did. I did not tell anyone in the office. Again, it's a small town. All these things could get out. It could taint the deal. People just get into your business. Like, keep it confidential, would be my two. Normal, like those are my two biggies. And it was it so much work. Oh my god, it was so much work. Like so much work. But man, know your numbers, um, and keep it confidential.
Yeah. And it's very interesting, of course there's the normalization of your P&L. That is something you hear about. Um in terms of, yeah, just making sure that you make those adjustments, if you pay for personal stuff and whatnot. When it comes to the other piece that you shared, about, like, the team members or the functions or the roles that the buyer is going to get rid of anyway. It's super interesting, because I had a conversation with Steve from Casago at the,
Mm,
the VRMA in
yeah,
Vegas recently, because I had a keynote I was going to give on this topic, on how to build enterprise value. And I wanted to pick his brain on a few things with regards
sure.
to the acquisition. And one of the things that, of course, came up is the fact that, like, Vacasa, one of the reasons why they went public for whatever they went public for, 4 billion or something, and then boom, when they sold, it was like for pennies on the dollar type of thing,
Yeah.
is because they thought they were a technology company, and in
Yep.
reality they weren't, and the market realized, they realized. So it's like, and it goes back to your point earlier about there being too many tools in this space, and being
Yeah.
able to get lost in having so many tools as well. It's like, know what adds actual value
Yeah.
to your company and what doesn't. And you know being more of an expert on this tool or that tool, or having an extra layer of technology. Nowadays you're seeing a lot of people wanting to build some tech as well if they get to a certain scale, because they
Sure.
think that that's going to build enterprise value, or keeping everything in house, right, is going to build enterprise value. What would you say are some of the misconceptions that you've seen when it comes to things that people do that they think is building enterprise value, but in reality they're just kind of wasting their time?
Yeah, it's. I mean, I was there for the Vacasa, so I was there pre-IPO. Um, saw the IPO, use some of their systems, and kind of got to see and hear them. That I 100% agree with Mr. Schwab on that. Of they would say that, hey, we're really a technology company that does some hospitality, and you're just like, oh no, you're not, right? Like, and I mean the public numbers out there of as to what amount of money they spent on their property management software and building it and maintaining it. Holy cow. Um, so yeah, I would say try and keep it simple, and like number of properties doesn't equate to profitability. So really be prudent with that, right? Like, my partner, here's a great example, right? So, here in Telluride, our annual is a little bit below 40%, right? Like we have good peak seasons, we have very low lows. And so we had 215 units and we had almost 40 employees. And I would have to go after properties, more and more properties, because I had more and more mouths to feed, right? I just was throwing people at it. My current business partner had 140 units, and we roughly had the same amount of gross revenue. And I had 215 units, she had 140. And our occupancies are roughly the same. She had a much smaller team, I had a much larger team. You know the difference between profitability and number of units. I was going more units, trying to eke out more profitability, but like the more homes you have, the more bodies you need, because it's a factor of time, right? Like you have more homes, you got to walk through them, you got to get them ready, you got to clean them. Like everything is time related. So really understand what you have, and that's to me, while and I'd flip it around. There's a mix, right? There's a mix of having kind of the right number of units and the profitability, because in the end, one of the factors that I got paid on, in terms of Latitude, was Yes, profitability, but number of units was very important in my equation of valuation. So like I got a good valuation because I had a lot of I had a lot of units, and yes, it produced a lot of profit, but the number of units was very important. So like there's a mix there. I'm not really answering your question very
Oh,
clearly,
100%. No,
but like
you are. I mean, and also like what you just said is true. Like you want to care about, you know, the unit economics. You want to care about, you know, profit per property more than number of properties. But like you said, you know, you also need volume, because depending on the type of buyer, that might play
yeah,
into how much someone's willing to buy you out for. You know,
sure,
the question in terms of, you know, what people spend time on, you also addressed it. You know, people spend time on, you know, trying to add more tools, trying to keep everything in house, you know, trying to add more owners at all cost versus more profitable owners
right,
specifically. And those are all things that lead to, you know, not necessarily more enterprise value. Um, what about, just to wrap it up on this? I looked you up, the management company that you currently run and started, and I was impressed by the volume of reviews that you got on Google, and you have like a 5-star review
yeah,
score, 147 reviews. Tell me about that, in terms of why you think that's important, how you've gone about it maybe, and also, yeah, like, just because it's a competitive space at the end of the day.
yeah,
And you know, why do you think this is important, and why are you proud of it?
yeah. I'm super proud of that metric. I'm also so we send out a quick survey on every arrival. Like it's a couple afters after someone's arrived, and it says basically give us your first impression, right? 1 to 5, 5 being the best, one being not so good, and we get their first impression. And if that first impression is if it's usually a 5, we go, okay, cool, great. Let us know how we can help. Blah blah blah. If it's anything less than a 5, we are very inquisitive of how we can fix it. Um, and some of the times it's like, I just don't like the location, and you like you try and do something, right? So you try and help someone out. We know the people that have given us 5s in terms of upon arrival. We don't bug them throughout their stay, but you know who's grumpy and who's not. And for the people that have had a good stay, we send them a request, and we don't give them anything. There's no, oh, and here's $50 off the next day. We just say, hey, please share, and we've been really good with it. So we don't try to game it. These are straight up honest reviews, and we care deeply about those reviews. I think it does matter. I think it also like I don't know if I'm a perfectionist, but I want people to have a great time, right? And we will do everything in our power to make sure that someone's having a good time, or we fix the problem as fast as we can, right? Because things are going to happen. The heat's going to go out. It might get hot here for a couple hours of the day during the summer. We'll figure something out, right? Like we have air conditioners that we can bring to people, even though it'll get down every night in the summertime. It gets into the 50s. It might get a little warm. Fine, we'll bring you an air conditioner. So like we try and go above and beyond as best we can, but we really just try and give them a good time, make sure that it's clean, like deliver on the expectations, right? And then fix something as quickly as possible if there's a problem. So
Yeah, no, and I love the idea of like the survey, you know, right after check-in, and being very proactive if it's
yeah,
anything less than perfect. Like, don't wait until they've checked out
don't
and
wait.
it's too late and you can't do much about it.
Yeah, and do something about it. Like if someone says, it's a 4, and you go, oh man, why was it a 4? And you go, there's not enough dish towels. Bring them more dish towels. Like, oh, I really wish there was another thing of coffee. Boom, another thing of coffee. Like, it doesn't matter, right? Like, don't cheap out on, well, I guess I have to go to the store and get some more toilet paper. Nope, we'll be there. Here's some toilet paper. It's just
I
stupid,
love it.
but
I love it. That's awesome. Well, listen, Kevin, this has been a true pleasure. Thank you so much for your time,
thank you.
and all the insights. It was really, really great to have you on, and excited to continue to see how you guys evolve and grow as well with the boutique mindset this time around. But equally as obsessed with quality and hospitality and everything related to the numbers as well. So looks like you guys have a bright future ahead, and thanks again for sharing all your insights.
Thank you so much for the time. Really appreciate it. It's good stuff.